Andrea, I want to start with the reckoning that still has yet to fully be realized. How much more is there to go in private market valuations?
Yeah, wonderful question, Lisa. And the reckoning is underway. What we're watching right now is shifts and changes in valuations in the private markets, which tend to lag the public markets by a considerable distance, actually. So far, what we can tell is across more recent vintage years, think 2017, 2018, 2019, and 2020. And vintage years is a common construct in which we talk about the private markets. The returns in those vintage years have dropped an average of 1,600 basis points from December 21 to third quarter of 23. And then for venture capital, those same vintage year performance, that those IRRs, if you will, have dropped 3,000 basis points. But we're not done yet, right? As we're waiting for the evidence of the companies that have been invested in, let's say the 21 calendar year, for their valuations to truly become more firm and more obvious to the rest of the market. So
Just
we're
quickly,
waiting.
just
That reckoning is underway.
Andrea, just to sort of develop a little bit more for people who don't think of things in basis points, if you're going to compare in any kind of apples to apples way, which I know that you can't, but if you were going to, public markets with private market valuations, how does that equate? We have seen significant revaluation in just benchmark treasury yields, right? 60% write-offs in some capacities. How would this compare in the certain private market assets?
So one of the ways we think about comparing the private market valuations to the public markets is we're watching the change in valuations from quarter to quarter, just like we would monitor the change in the valuation of the S&P 500, Lisa. And so one of the things we've noticed from COVID is that venture capital valuations spiked up by 90% as of December 21 and are now hovering at around 50% above COVID valuations, sort of the teeth of COVID, if you will, while the S&P 500 is up 75% from its COVID low. Let's use that as an example. So there's been a lot of volatility in the venture valuation. From a private equity valuation, it's actually been hovering at around 50% above COVID low and kind of just trending along sideways at the moment. So private equity is actually going to be a very interesting market to see where valuations head given the increased interest rate environment and a lot of the unknowns that have become known affecting exits for that cohort of deals that were done a few years ago.
And you pointed to the idea that fundraising has really lagged, that it's at a 7-year low. You were pointing this out. So there's a question of where the opportunities are in the future and also how you get access to capital to invest in those opportunities.
Yes. So as you well observed, fundraising, it looks like it's trending to be at a very significant low compared to the last, let's say, 5 years, which actually means a couple of interesting things for investors that are able to invest today, right? Which is this year, 23, potentially 24, despite the increased interest rate environment, could be very good vintage years because capital is dear. There just isn't a lot of money coming into the market, which means there's less money to go into the transaction environment and acquire companies and potentially not aggressively bid up valuations, which are no longer supported by a zero interest rate environment either. So could be a very interesting investment environment for those looking and able to commit capital today. And Lisa, the one thing I'll add on that, because there's been a distribution drought, it's more difficult for certain LPs who may not have been receiving that capital to turn around and reinvest it into the markets. So again, it's a tight market, which could be good from an investing perspective.
How much are some of the LPs who you're talking to thinking about just the asset mix, about how much debt versus equity they really want to be going to? Since private credit, people are talking about a golden era, and private equity, people are saying, it's probably going to atrophy here.
Interesting question. And what I would say is private credit obviously looks much more interesting today, given the increased interest rate environment, tighter, let's argue, tighter, more calibrated underwriting that's happening, more honest EBITDA measurements being used to determine the level of leverage, among other things. And so the returns coming off of private credit are very attractive relative to where they were several years ago. And what I would say is institutional investors that are looking to augment or complement their fixed income exposure may fund private credit from that fixed income bucket, if you will. But some private credit strategies are knocking on the door of private equity returns in certain corners of the market. So we are definitely seeing an increased interest in private credit relative to private equity. From a private equity standpoint, Lisa, what I would say is many investors may have been overserved. Certain types of high aggressive, non-profitable growth tech strategies, and maybe wanting to augment that by adding some more value oriented or defensive
Yeah.
types of companies into their portfolio.
Just quickly here, I'm wondering, Andrea, how much do some of the LPs who you speak with count on yields returning back to something much lower than where they are now in order to make some of the investments work over the long term?
Given the investors that we work with at Cambridge Associates, many of those investors are expecting their illiquid book to ultimately deliver significant returns of capital so that they continue to field and fuel their specific mandates. And from a yield perspective and a private credit perspective, depending on the type of investor, insurance companies, pensions, et cetera, may really need to rely on that yield in order to fuel their programs for their constituents. So it's always a mix depending on the type of investor we're talking about.